A very good morning to all of you students. My name is CA Divesh Gupta and today we will be discussing about the topic on derivatives. So let's start with first of all having some of the basic understanding on derivatives. Then we will go through some of the questions and towards the end we will do some of the MCQs as well. Good morning. So to start our discussion, we are taking an example of two different elements into our discussion. One is, let's say, A and second is B. So these are the two different elements which will be used throughout the discussions to discuss about derivatives. Now, what do we mean by derivatives? Derivatives is something that derives its value, right? So deriving a value is derivative. Now, who derives from whom? So let's say A derive its value from B. So can we say that A derive its value from B? Or can we also say that A's value is dependent on B? One or the same thing, right? Whichever we want to say, that if A is deriving its value from B or A's value is dependent on B, such that in whatever value B increases or decreases, there is some impact on A that happens. Okay. So in this type of arrangement is called derivative, and A is called as a derivative because A is deriving its value from an underlying. So what we call B here is called as underlying. Underlying means what is the basis, what is behind the value, that is called as underlying, right? So B is an underlying. We will come through what can be underlyings. Okay, just allow me some time. All these things we will be discussing. Okay, so A is deriving its value from B. B is an underlying because B is having its independent pricing movements and A pricing movements is dependent on B. So we call A as derivative. At the same time, this movement dependency, the price movement dependency in A will be in the form of a financial instrument. So financial instrument is a financial contract which involves paying or receiving money. Okay. So wherever there is an obligation to pay, wherever there is a right to receive. Okay. I hope you're able to make it out. Obligation to pay and right to receive. The money, the contract which defines that obligation or right is called as financial instrument. However, there will be certain terms and conditions attached to it, right? That is, for example, the value of A will be dependent on value of B. This is one of the terms and conditions, right? So this completes, the basic part wherein we are saying that A. So first of all, in a derivative situation, there has to be two different elements, one A and one B. A's value is dependent on B. B acts as an underlying and A acts as a financial instrument. Clear, students? Now let's elaborate on what can be different types of underlying. Does anyone want to attempt this? It would be good if we make this discussion more engaging.
The commodity, Sensex, Nifty, foreign exchange, like that.
Very good. So there are different kinds of underlying. As you rightly said, one is commodity. Right? Commodity means what? Commodity is, let's say, oil, let's say gold, let's say things, let's say pulses, right? Let's say those things which are homogeneous in nature, right? Which has single stated use. So those are commodities. Second, equity, right? let's say equity of X Limited. Any company you want to take, you can take their equity share price that can act as an underlying. So there will be a derivative on that equity of X Limited that will derive its value from the way the movement in equity happens. Okay. So second underlying can be equity. Third, it can be foreign exchange. By foreign exchange, we mean the currency, the foreign currency. Let me write foreign currency only here. Slash exchange. Okay. So let's say $1 is equal to 83 rupees. So the price of $1 is how much? 83 rupees. That can act as an underlying, and there can be a derivative on that underlying of $1 that can act as a derivative, and that can derive its value from the way the dollar is priced in terms of the foreign exchange. Okay. Fourth, there can be index. As it was rightly said, it can be Sensex or Nifty. What are Sensex or Nifty? Sensex or Nifty are different types of indexes. Index means the collection of certain, let's say, companies in this context, which for which the price movements are tracked on a year-on-year basis. And that's where we say that, okay, now the pricing is this much, the value of that index is this much. If in the base year it was 100, now it is 3000, that means 30 times the index has grown. Okay. So Bombay Stock Exchange and National Stock Exchange, for this we have Sensex, for this we have Nifty, right? So there can be index. Another important one. So all these are financial underlyings, right? Wherein there is some or the other financial part related. There can be non-financial underlyings as well. For example, weather. Okay, because weather is a natural condition. Even the weather related outcome can be an underlying, and there can be a derivative acting on that weather as an underlying as a derivative. So you see, there can be many different forms of an underlying. And derivative, when we talk about derivative always needs to have an underlying to derive its value. And this arrangement is called as derivative. So this discussion is revolving around these cases. Okay. Any questions till now, students? So now let's come to the basic features of derivatives. Okay. To understand it in further detail, let's talk about basic features of derivatives. So for any such underlying, there is a buyer and there is a seller, right? So how do we define a financial contract? See, any contract will have at least two parties, right? At least two parties, which is, let's say, a buyer and a seller. So even derivative, for that matter, will also have a buyer and a seller. So for this A instrument, which is a very different instrument from B instrument, okay, will have its own buyer and seller independent of B's buyer or seller. Are you getting my point? So let me explain. The buyer and seller. This will be buyer of A will buy A, and seller of A will sell A. Okay. So we discussed above that A was what? A was derivative and B was underlying. Correct? This is what we have discussed above. So, for example, X and Y are buyer and seller of derivative, and for this underlying, just to make it quite clear, let's take M and N as buyer and seller. For example, let's talk about this equity, right? There is a specific company for which we are talking about the equity shares. So for that equity, the underlying is equity. So M and N will act as buyer and seller. And for A, which is the derivative on that equity, there will be different buyers and sellers. Clear? Yeah. Then the second feature we already discussed. This is the first one. Let's go to the second one. The value of derivative is dependent upon value of underlying. Okay. Third, now any contract, if you see, apart from having a parties to the contract, it also needs to have a validity, right? For example, it is valid for 1 year, it is valid for 1 month, 2 months, 3 months, 6 months. So it needs to have a fixed tenure. So fixed tenure of A, which is a derivative. It can be 1 month, it can be 2 months. Likewise, it can be, let's say, an year. I'm just taking n year means, let's say it can be 1 year, 1.5 year, 2 year, it can be anything, right? But it has to have a fixed tenure. Then, once the parties are defined, the underlying is defined, the tenure is also defined, it also needs to be defined, or it also needs to be understood that how the settlement will happen. So eventually, once the tenure is over, after that there is some settlement that will happen, which is the, let's say, some party will give to other party amount, right? Or let's say the other party will give some of the deliveries. So we'll discuss how the settlement will happen in different scenarios, but there has to be a settlement that needs to be done, students. Okay. So here we talk about settlement, in which case the net payoffs from buyer to seller, or net payoff from even seller to buyer also, it can happen. Okay. So please be watchful about it, that in general underlying transaction, only the buyer pays to the seller, right? But here the net payoff can also happen from seller to buyer. Okay. So these are the four features of derivatives. Okay, that means it has to have a buyer and a seller, different from the buyer and seller of the underlying. The derivative will derive its value from the underlying. The third is it has to have a fixed tenure, and the fourth one is the settlement is also part and parcel of the derivatives transaction. Now there are certain things which are fixed or certain. Certain means it is defined. Certain slash fixed. And there are certain things which are uncertain, which are not defined, which can be variable. What are the defined part in such contract? In this contract of derivatives, what are those elements which are defined? One is underlying. Underlying means what is going to be the underlying here. Quantity of underlying. So quantity of underlying means that how much quantity, whether the underlying will be equal to 1. So one derivative on equity share of X will be 1 is to 1, or let's say 10 share of equity share of X will constitute as one derivative, right? So the quantity will be defined. Quality of underlying. Imagine in case of commodity, there is a crude oil. Crude oil, there are different grades. So even that will also be defined, that which quality we are talking about. So you are seeing that the specifications have to be very specific here when we talk about these aspects, the underlying quantity, quality, right? And then the time period, right? What is uncertain or what is dependent on the price movements was the prices of derivative. Yes, good. Mr. Saminathan is saying in case of gold, it can be the carat of gold. Yes, the quality part. So the price of derivative is something that is not fixed as of now, right? It is bound to move the way your underlying moves. So it is something that is variable. Okay. Now let's come to the main part of derivatives. I hope with this ground understanding, all of you are able to understand that what are the basics of derivatives. This is a very interesting topic, students, and very easy, I would say. Okay, so don't miss any part. Just ask any questions wherever you feel you are stuck so that your understanding can be built. So now let's come to the types of derivative, students. The first one is forward contract. Let's start from the easiest one, the forward contract. Okay. Again, let's take an example here. Let's say there is a company, and in that company there is a procurement manager. Okay. The function of a procurement manager is what? To procure the raw materials, packing materials, and the items, consumables, all those things, right? So there is a company in which there is a procurement manager, and that procurement manager has been given a task to procure crude oil. Okay, let me just write it specifically, to purchase crude oil. It has also been defined that grade A crude oil needs to be purchased. How much it has to be purchased? 20 liters it has to be purchased, the quantity. But the condition is that it is not needs to be purchased today. It needs to be purchased 6 months from now. So the delivery after 6 months from today. Today price is, let's say, rupees 100. After 6 months, the price is likely to go up. So there is an expectation that after 6 months, the price is likely to go up. But we need delivery after 6 months, not today. Today's price is at 100. Now, what does procurement manager executes with one of the supplier? So the procurement manager goes and says that, okay, we need 100 liters grade A, 20 liters grade A crude oil. The delivery is needed after 6 months. So the supplier says that, okay, you can come on after 6 months and then I will give you the stock. But procurement manager internally knows that the price is going to go up. So procurement manager says that, okay, why can't we do a deal in which let's lock the price today, right? And then you give me delivery after 6 months. But let's enter into a commitment that I will buy 20 liters of crude oil from you and you need to supply 20 liters of crude oil to me at such and such price. But the deliveries can happen after 6 months. Clear? Because if this step is not taken, then procurement manager for sure knows that there can be a loss in the time to come. So what it does, what procurement manager says is that they are locking 110 per liters as the price, okay, and in turn will supply 20 liters of grade A crude oil. Clear? So what we are doing is we are locking the pricing at 110 per liter and supplier will supply 20 liters of crude oil. Now you would be thinking that why so? Because the current price is 100. After 6 months, the price would have been, let's say, 120. But this procurement manager is able to convince the supplier to supply at 110, which is slightly higher than 100 rupees. Now, this is actually taking the form and shape of a forward contract. Why forward contract? Because the commitment or the financial contract or the financial instrument is happening today, but it will be executed after 6 months at a pricing which is dependent on the current market price of the underlying. The underlying is also defined here, crude oil, quantity and quality as well. Now let's see what happens after 6 months. Here there is a procurement manager. There is a actual price, negotiated price, and the supplier. Okay, now let me explain what is happening here. Case 1. Let's say the actual price in case, okay, let me write case 1 here. These are the different cases. Okay, in case 1, the actual price turns out to be 115. Now students, please focus. The actual price in market after 6 months becomes 115. The negotiated price was how much? 110. So in this case, the actual supplies will happen at 110 because of the commitment, but the price in the market was 115. Now, can anyone tell me that this supplier, the supplier will be at a loss or will be at a gain of this 5 rupees?
At a loss.
Supplier will be loss, sir. 5 rupees.
Perfect. Supplier will be loss of 5 rupees. Why? Because there is an opportunity missed here. opportunity to sell at 115 what is currently being sold at 110, sorry. Okay. Now the procurement manager will have a 5 rupees gain or a 5 rupees loss here.
Gain, sir, 5 rupees.
Yes, because if they would have not entered into this forward contract, they would have ended up purchasing it from the open market at 115, and hence they would have paid 5 rupees extra. Now, because of this arrangement, they are paying 5 rupees less, and hence there is a 5 rupees gain here. Now, let's take second. Let's say the price actually is only 95 against the negotiated price of 110. Now, let's try to understand this. There is a contract to supply at 110. The market value of that is 95 only. The supplier will be at a gain or will be at a loss?
Gain, sir, 15 rupees gain.
Yes, 15 rupees gain. And similarly here, 15 rupees loss.
Loss.
Because the procurement manager would have gone and purchased in the market at only 95 rupees. What this procurement manager is purchasing now at 110, because of this obligation, there is a loss to the procurement manager. There can be a third case as well, 110, 110. There is no gain, no loss to any of the parties. Okay, yes. So that is how the forward contract is deriving its value either from the supplier and procurement manager standpoint. Whereas, let's say 5 rupees gain here, 5 rupees loss there. Here 15 rupees loss, here 15 rupees gain. So that's how the pricing of this forward contract is getting derived. And what is the element here? This one. So this 115, 95 or 110 is actually taking its value, right, to 5 rupees gain, 15 rupees loss or nil or whatever the case may be. So that is where it is called as a derivative. Clear? Now let's talk about the settlement of this, how the settlement would have happened. And here we are talking about specifically for forward contract. Okay. After 6 months, procurement manager and supplier. So this procurement manager will pay 20 liters equivalent 110. So that means 2200 rupees will be paid to the supplier, and supplier will deliver 20 liters of oil. Okay. Now, if you see, a basic takeaway from this discussion is that this contract was customized to the requirements of procurement manager and supplier, right? Customized means this was over the counter. Over the counter means that we are sitting on a table. Both procurement manager and supplier is sitting on the table, and they can decide the terms and conditions according to their own choices, for which both of them can agree. At the same time, forward contract is not a standard contract, right? It's not a standard one. So standard contract will mean that always the contract has to happen for 1000 units. 1000 has to be the lot size. Why 20 liters? Why 6 months? It should always be 3 months, right? So those are the standard terms and conditions in a contract. But forward contract, there is no standardization. It is over the counter, which is customized. Yes. Sorry. This is customized. Okay. And the settlement is happening basis the gross. Gross basis means that the entire amount will be paid and the entire deliveries will be taken. Right? Just now we discussed how the settlement is happening. Clear, students? Please do let me know in case you have any questions till now. Then we will move
Yes.
ahead accordingly.
Yeah, I have a question.
Yes.
Is this a binding agreement? Forward
Yes,
contract?
this is 100% a binding agreement, because if you don't honor the commitment, you will end up having repercussions what is mentioned in the contract, right?
Right. So why I was asking, because 95 rupees was the actual price in case 2. Why would he purchase from him at 110?
That's a very good question. But since the agreement stated and procurement manager was bound by that agreement, they will have to honor the commitment. Okay, so that is where in case in case you need that flexibility to make a decision, if the price is favorable to me, I will execute the contract. If the price is unfavorable to me, I will not execute the contract. Then there is another type of derivative which is called as options. Option means you have an option to execute or not. Okay, we will come to that. That's the third part of our discussion. So forwards, as far as forwards are concerned, these have to be executed mandatorily. You don't have any choice here. You don't have any option here. Okay?
Right, yes. Thank you.
Sir, I have one question. Is that forward contract is a regulated market? How the risk will be handled when there is a default of that buyer or seller on the promise of the contract?
Yeah. Okay. So it's not regulated as such because it's not a standard contract. And to your second part, whether how the risk will be managed. So yes, for managing the risks, it will also be defined in the contract that in case of a default by the buyer, what will be the repercussions? In case of default by the seller, what will be the repercussions? And just to tell you practically where forward actually happens. So most of the forward happens with banks. Okay, with and specifically that too on the foreign exchange, right? Let's say I am going to receive some of the foreign currency 6 months from now, so I will enter into a forward contract with the bank that I have to sell that foreign exchange to you today itself at what rate. So practically these places are where the forwards are done. But at the same time, in those contracts, even the risks will also be specified. In case of default, what will happen? And any which ways, you are agreeing to that overall contract, right? So you are agreeing to that risk as well.
So for bank is fine. Anyway, they will follow the procedure. When it is executed on the individual basis, the risk
Yeah.
will be high, right?
So the risk will be there, but at the end of the day, that person is also a customer to the bank, right? So the bank will always have the rights to hold that person accountable. Correct. And then there are definitely, if let's say the person or let's say the customer is not performing their rights, performing their obligations under the contract, there are other judiciary recourses that are available. Correct, because it's a valid contract. It's a legal document.
No, I am not talking about the bank, sir. See, the forward contract can be done other than the bankers also. Say, example, individual to individual, the forward contract
Correct.
can be done. See, in
Correct.
that case, the risk is high. That's what I am saying. There is a dishonor of that contract.
No. So the similar risk appears in any other commercial contract. Okay. See why? Okay. Why are you saying that the risk is higher in this and in not in any other commercial contract? I am saying that just view it as any other commercial contract. Let's say a commercial contract of a sale or a purchase. Right. Today I am selling goods, and I am saying that I allow you 90 days of credit period. Don't you think there is a risk there as well that whether I will receive my collections or not after 90 days? So similar risk is here as well, that after 90 days, whether the execution will happen by both the parties or not.
Okay, sir. My worry is that since it is not a regulated market, there nobody is there to help out. Whether this contract is legally is binding the contract.
Yeah, it's very much legally binding. See, in case, let's say, so that's where the forward contracts come in, that you want to customize your contract, you can do that. But at the same time, if you want some sort of regulation, right, in your contract, then the next part of our discussion is futures. So in futures, they are regulated by a stock exchange. In case you're not comfortable with forwards, you can enter into futures. But futures will have standard terms and conditions which will have to be abided with. In that case, there is a regulation in place. Okay?
Right, sir. Thank you, sir.
Yeah. So now let's come to futures. So futures. So the first part we discussed about forwards. Now let's talk about the futures. In case of futures, futures are also financial instruments. Okay. But in such a case, these are standard contracts wherein the quality, the quantity will be defined. Let's say the lot size is 1000. Okay, so it will be defined in the contract because it is listed on a stock exchange, dealing in a stock exchange, regulated as we discussed. So the lot size will be standard here. Okay, and here the settlement will happen on net basis. So that means there are net payoffs. There is no actual delivery that will happen. So for example, in this case, the settlement was happening in this form, right? Where the material was being received and payment was being made. But in case of futures, this net amount will be settled. Okay. In case of a gain to the procurement manager, the amount will be received by procurement manager from supplier. In case of a loss to the procurement manager, which is the second case, the amount will be paid by the procurement manager to the supplier. Okay. Then futures are traded on stock exchange. Okay. So futures are very similar to forwards the way this instrument is designed. So the instrument is designed as such that in future some buying or selling need to happen. For that, the price is being fixed today and the actual execution will happen after 6 months, right? The only thing is forward contract is a customized contract. It has to be settled on a gross basis that we discussed, right? The futures are very much standard contracts. The settlement happens on net basis, and that's where they can be traded on a stock exchange. Because if you are entering into very customized contracts, the n number of contracts, all of them cannot be traded on stock exchange, right? For trading on stock exchange, some homogeneity needs to be there, some standardization needs to be there. Okay. Now let's discuss some of the further things. Now, going forward in our discussion, I will be using the underlyings as equity shares of X Limited because that is where the major focus is. Okay. So we will always assume that there is an underlying of equity shares of X Limited. Now, case 1. The prices are going up in the time to come. Now, price are going up in the time to come. Now, students, comes a very interesting part. Now, let's say you have been given this situation, or you know through the market intelligence that the prices is going to go up in the time to come. For example, there can be a shortage of crude oil in the market, or specifically for X Limited, equity share of X Limited, the X Limited is going to enter into a very huge amount of a contract, which is going to be giving a very good push to the top line and bottom line of X Limited, right? And hence the prices are going to go up in the time to come. Now, in this case, what will you do? Whether you will buy the future or selling future. Now, let me also clarify, what do we mean buying and selling? So the buying and selling means that in this case, the procurement manager was in the buying position and the supplier was in the selling position, right? Even for this forward, the procurement manager ended up buying the forward contract and supplier ended up selling the forward contract. Clear, students? Now tell me, the question comes that in such a case, whether you will buy the future or sell the futures if the price is going to go up, so that there is a benefit to you.
Buy the future.
I will sell the future, sir.
Sell, okay. Why will you sell the future?
Because when I am selling the future, after selling it, I will buy it from, say, I will get the gain out of it. Say,
Okay.
example.
So, okay, let me explain. I thought I'm able to get what you are saying. Okay, let's come to this table and let's try to understand from this. So, if you see the price, it's a negotiated price here, 110. So, here the prices have gone up. In the second case, the prices have gone down. And in the third case, the prices remain constant. Okay, so we will take our inference from this. So, the moment the actual price of 115 has gone up, the person has gained, that person has gained who was sitting on the buying position. Okay, and this person has incurred a loss which was sitting on the selling position. Clear? Because of this very similar fact that the contracted price was 110, the actual price was 115. So the person who is in the buying position will have a 5 rupees benefit because they don't need to spend 5 rupees extra in the market. Similarly, when the prices have gone down to 95, the person sitting in the buying position incurred a loss because they will have to pay 15 rupees extra because of this agreement to purchase that specific crude oil. Clear? So, here also, the case is that the prices are going to go up in the time to come. We will actually buy the future. We will not sell the future. Okay? Because what will happen, today I will buy at 100 and the price will be 120 later on. I will sell at 120 later on, buy now at 100, and hence there will be a 20 rupees gain that I will make. Clear? Case 2. Price is expected to go down in time to come. Come on, students, tell me now.
Yes, sell the futures.
Yes.
We'll sell the future, sir.
Perfect. We will sell the future. Very good. Because, okay, now let's demonstrate this as well. Buy future or sell futures or do nothing. So we will be selling the futures. We will be not resorting to these two options. Okay. Now comes a very, very important part of the discussion, students. Now please hear me out. So buying and selling, okay, these are two different elements, these are two different parts. Buying we also call as long position. Selling we also call as short position. So you will see in lot of the questions short position will be used. So you can assume that the question is telling you to take a selling position, wherein that you are selling the item, selling the financial instrument. The long position means that you are under a buying position. Okay. Now, can you make money if you know that today the price is 120? Okay, see, let's take a simple example first of all. If the price today is 120, it is going to go up to 180. You can very well make money, right? You can purchase the share today. I'm just talking about the underlying first. You can purchase the share today at 120 and you can sell it at 180 later on. And then 60 rupees you can pocket your profit. But let's take a reverse situation wherein today the price is 120 and you know for a matter of fact that the price is going to go down to 100. Okay. Now in this situation, can you make money? So let's say this is today is what? Today is okay, let me take a 1st September and 30th September. So after 38 days, the price is going to go down. Now, in this situation, you are standing on 1st of September and you very well know that the price is going to go down. Now, in this case, can you make money by selling or purchasing the share? And if yes, then how? Come on, students, tell me.
Sorry, if the price is going down, then we can put the sell position, short position.
Perfect. You can do the short position now. But the moment you do a short position, and I think Chitra is also saying sell it now for 120 and buy it at 100 later on. I agree to it. But my question comes, the moment you sell it in the stock market, you need to hold those shares before you sell it, right? You cannot sell what you don't have today, because for this the settlement will happen on 2nd or 3rd, right? For this selling, the settlement will happen 2nd or 3rd, wherein you will receive the amount of 120 from the buyer of this transaction and you will have to give one share on this date to the buyer, but you don't have the share today, right? So is it possible for the underlying? Okay, now let me explain. I think the strategy that you have devised is totally correct. In case the prices is going to go down, it has to be sold today and purchased later on. The strategy is totally fine, but the strategy will not work in both the markets. So students, you would be knowing that there are two segments or there are multiple segments in the stock exchange. I'm picking up two segments here. One is the cash market or the spot market, which is for the underlying, right? There is another segment called as futures and options market. This is called as FNO segment, futures and options market. So just now after today's class, you can just go through, let's say any of the channels wherein, let's say these channels are there where they keep on showing the Sensex Nifty, right? In that you can just see that they will be also showing you the FNO segment separately, how the FNO segment is doing. That is called as futures and options segment. So in this futures and options segment, futures and options are traded. Okay, options we have not discussed till now, futures we have discussed. Okay, now in cash or spot market, can you take long position? The answer is yes. Can you take long position? The answer is yes. Now the strategy here that we devised, wherein we know that the prices are going to go down, this is called as short selling. Okay, short selling means that you are selling something that you don't have, and then later on you will purchase. So this short selling in cash segment or in the cash market is allowed or not allowed, students? Come on, tell me. What do you think? Okay, let me explain. Yes, it is not allowed. But if it is within intraday means within the same day you are purchasing and selling, or within the same day in the morning 10 o'clock you are selling and evening 3 o'clock you are purchasing it back, that is allowed. Because within the same day you have squared up your position. Okay. So intraday it is allowed. Interday it is not allowed. In this case it was interday, right? Interday means that one day you are purchasing and after some days you are selling, right? Interday means this. So interday it is not allowed, because if today you sell it and after 5 days you purchase it, you don't have something to deliver. However, in futures market, the short selling is very much allowed, because in this case, by selling the future, you don't need to deliver the shares, because future is totally separate from the shares. I hope you're getting my point.
Yes, sir. Got it, sir.
Got it? So futures are totally delinked to the underlying shares. Clear? So underlying shares can have buyer and seller, let's say A and B. Futures will have buyer and seller, let's say M and N, some third party, some different parties. Okay. I hope I am able to clear this out. This was the very, very important part with what we have discussed here, right? So let me just repeat it for just 2 minutes and then we will connect it to the next part. Okay. So first of all, students, forwards and futures are very similar in terms of the way they are devised as an instrument, wherein there is a need to deliver, there is a need to buy after some time from today. The prices are fixed today. Their prices are actually dependent on the actual movement of the underlying. Now, if we know that the prices are going to go up in the future, so what we will do, we will buy the futures. Okay, we will take a long position in futures. If the prices are going to go down in the time to come, we will short sell the futures today, and then we will take a buying position later on once the prices are down. But the similar thing cannot be applied in cash market or the spot market where the actual equity shares are being traded, because in that case we will need to have those shares if we want to deliver them. Okay, students. Now, cash segment, forwards, futures. Okay, cash segments is where the underlying is traded, right? For example, the equity shares. Forwards are where the OTC, which is over the counter customized contracts, are dealt with, and here the settlement happen basis the actual basis, 100% gross basis. That is how the settlement will happen. That means I need to take the physical delivery of the crude oil. I need to pay the amounts on a totality basis to take the physical delivery. Okay. Futures, standard contracts. These are traded on stock exchange, and in this case net payoffs are given or paid for settlement, students. Okay, perfect. Let's move to our next discussion now. So the next discussion is around pricing. Okay, so till now we have discussed that what is the strategy in case the prices are going to go up or down, but how we will determine the pricing of the forward or future. Before we move to that, let's clear out some of our concepts on compounding. Okay, so what is generally a compounding formula will look like, right? Where we say that A is equal to future value, P is equal to present value, R is equal to rate of return, T is equal to time period, students. I hope this is clear, right? This is just a very simple formula that I have put in. Now, if we see that there is a semi-annual compounding, there can be some of these complexities as well, right? Semi-annual compounding. Semi-annual compounding will be A is equal to P, 1 plus R divided by 2 and 2 multiplied by T, right? Because now twice the compounding will happen. R is annual rate of return. So that we will divide by 2 for 6 months, and compounding we will multiply it by 2. So here T is always 1 year and R is equal to per annum rate. That's what we always assume in the our formula as well. Here as well, that R is per annum and T is equal to 1 for 1 year. Okay. So can we derive this formula now? For whatever intervals we have, A is equal to P, 1 plus R divided by N into T. Okay. Where A is equal to the future value, P is equal to present value, R is equal to rate of return percentage per annum, T is equal to time period, where we always assume is equal to 1 year as 1, and N is equal to number of compounding in a year specifically. Okay, so let's say there are 4 years. Okay, let's take different examples so then we will be able to understand it better. This is clear, students? This
Yes,
is just
sir.
a very simple formula. Yeah.
Yes, sir. This is good, sir.
Okay, perfect. Perfect. So let's take now different examples just to corroborate this understanding. R is equal to 10%, T is equal to 3 years, and compounding is quarterly. Now tell me, what will this formula be looking like? A is equal to P 1 plus. Now tell me, students, R I should put 10 here.
Yes, sir. Or 10
10%.
divided by 4 quarterly.
Okay, perfect. 10 divided by 4, which is quarterly. So this rate becomes now quarter rate. And what should I do here?
Then 4 into 1.
Into 1 or 3? 3, right? Because
Yeah. It is 3 years. Yeah, totally
it
3
will
years.
be 3. Yeah, it will be 3. The reason why I'm doing 3 is because for every 1, t is 1, and for 3 it will become 3. Okay. So this is something that is called as discrete compounding. So discrete means having some intervals in between. That is called as discrete compounding. Okay, now let's come to the formula of continuous compounding. Okay, so the formula of continuous compounding. So okay, there are two ways the way you can compound. Okay, see, there are two ways. One way to compound is actually in specific intervals, every quarter, every month, every week, every day. That is called as discrete compounding because you're compounding at some intervals. Then there is a concept of continuous compounding, that every second, every millisecond, the compounding is happening. I hope all of you understand the concept of simple and compound interest, right? I'm not going through that. So simple interest means that the interest is not added on interest, but compounding interest means that the interest is also paid on the interest which is not yet paid. Okay, so this is all about compounding that we are discussing. So the continuous compounding assumes that there is infinite number of compounding that is happening in a particular time frame. For example, every millisecond the compounding is happening. So it is assuming that n is actually infinity. N is actually the number of times the compounding is happening in a year, right? That it assumes that it is infinite. So the formula here actually becomes P, A is equal to P e raised to the power R into T. This is the formula of continuous compounding, where A is actually becoming the future value, P is actually the present value, R is equal to the rate percentage per annum, and T is equal to the time year. 1 year is equal to 1. And E is actually the exponential function. Okay. So this E raised to the power something will always be given to you in the question, right? You just need to put this formula and solve for it. Okay. Now let's come to the concept of valuation of forward/futures. Okay. The present value, which is equal to the spot price, can be transformed into the future value of spot price, right? Using the above formulas, you can just take the present value. Okay, so the spot price, which is the underlying price as on today, is called as the present value, right? It can easily be transformed into the future value using the above two formulas. In case there is a continuous compounding, we can use this. In case there is discrete compounding, we can use this, correct? So using that, can we arrive at the future value of the spot price? The answer is yes. The price of a forward of forward slash future will become the future value of spot price. And here the expiry will become the time period for compounding, right? Time period for calculating the for calculating the future. Let's say time to expire is 1 month. So the expiry of 1 month will become the period for which the compounding will happen. Okay. And just rewriting it, discrete compounding. A is equal to P 1 plus R divided by N into T. And continuous compounding, A is equal to P e raised to the power R into T, students. Okay. One more thing. Let's say today the whatever is the spot price, I am assuming it to be 100, okay, of X Limited's underlying. Okay. So there will be three different futures that are running on this at any given point of time, which is 1 month expiry, 2 month expiry, 3 month expiry. So the 1 month expiry is 101. Now tell me, students, 2 month expiry future, the value will be what? Will it be higher than 101 or it will be lower than 101? Come on, students, tell me.
Yeah, it will be higher than 101, sir.
Correct. It will be higher than 101 because the timing to expire is higher. So that means the interest element would also be higher. So the difference between future value and present value is the interest part, right? So the future value needs to be higher. Similarly, 3 month will be further higher. Let's take 103. Okay. So can I say that rupees 101 is the future value of rupees 100 after 1 month? Clear? So after 1 month, the future value as on today of 100 rupees seems to be 101. Clear, students? Any doubt, any other question? Please do let me know. We will come to the questions. We have lot many questions. Treatment of dividend and transaction cost. Now comes the additional part. Dividend and transaction cost. Okay. Treatment of dividend and transaction cost. 1. Discrete dividend. Now dividend can also be in the form of discrete or continuous, right? So A is equal to P minus present value of dividend multiplied by 1 plus R divided by N raised to the power Tn. So students, we are talking about here as the P, which is the spot price. From that, we will have to reduce the present value of dividend. Now, let's say the dividend is payable after 1 month. We are talking about a 3 months futures, right? So, first of all, from today's value, we will reduce the present value of the 1 month's dividend payable, and then that value we will take it after 3 months. Why we are reducing dividend? We are reducing dividend because dividends are never paid on forwards or futures, right? They are only paid on the spot, and the spot price is always increased by the dividend value. Clear? It is always increased by the dividend value, the spot price, because the moment you keep on accumulating your dividend into your spot price, it keeps on increasing. But futures, there is no dividend that is to be paid. Then P minus present value of dividend plus present value of transaction cost. So transaction cost always gets added, students. Please do remember, dividend is always reduced because it is already part of the price, but transaction cost is always added, right? Because today if I want to go and deal with the shares in the market, I will have to end up paying the transaction cost being extra, right? So A is equal to P minus present value of dividend plus present value of transaction cost multiplied by e raised to the power r into t. So this will happen in case the dividend is discrete but compounding is continuous. Okay, so this is that formula. Now the second part, let's take as the continuous dividend. The first part was discrete dividend. Let's take the continuous dividend. Okay, so the continuous dividend will be A is equal to P e raised to the power r minus y into t. So this is very, very important, students, as most of the questions this will be used. This is a very simple formula. Here y is equal to dividend yield and rest all things remain same. A is the future value, T is the time period to expire, P is the present value, R is the rate of interest per annum, and Y is the dividend yield. So here we are saying that whatever accumulation will happen, that will happen at the rate of R, and from that the Y, which is the dividend yield, will keep on pulling the future value down. Okay. Now what happens on expiry? On expiry, can anyone tell me the price of future will be equal to what? Come on, students. On expiry, the price of the future will directly be equal to what?
Price of the spot price on that day, future.
Yes. Yes. So it will be equal to the price of spot. Correct? Now, because there is no expiry, or let's say the time period to expire left, so there is no interest. If there is no interest, the future value and the present value will become same. This can be even showed using this. Okay, so this is expiry moving into this direction. This is difference in future price versus spot price. Okay, so the difference in future price and spot price, which is actually the interest element, the absolute interest. So it keeps on going down. The difference keeps on going down as the expiry increases. And here, if let's say there is an actual expiry, it will become zero. This is future price, this is spot price, let's say. So 102 and 100. Let's say 2 rupees was the difference, right? Now, after 1 month, the spot price become 110. Now tell me, students, in which direction the future price will move? After 1 month, the spot price has moved from 100 to 110. The future price now will be calculated on 100, also sorry, on 110, and let's say it becomes 111. Then let's say on expiry, the spot price becomes 105. Now what will be the future price on expiry? Come on, students, tell me. It will be 105. Here the difference was 1, here the difference is 0. So can you see, the moment we are approaching the expiry, there is no difference that is there between the future price, and the spot price, right? There is no difference between the future price and the spot price. Any questions till now, students? I would be very happy to take them up. So ultimately, now what is happening here? The future price, which is a derivative price, is deriving its value from the movements in the spot price, 100 becoming 110, 110 becoming 105. And similarly, the difference, or let's say the premium at which the future price is trading with, is because of the difference in the interest elements based on the time to expire. Let me check the other query handle as well. Yeah, there is nothing. Okay, now let's come to the uses of derivatives, specifically futures and forwards that we have discussed. Sorry, just a second. Just give me a second. Yeah. So let's come to uses of derivatives. So speculation. What do you mean by speculation? Speculation means is to speculate, is to think on two lines. One is hope of gain, with a risk of loss. So there is a risk that we know that there can be a loss, but at the same time, we are hoping that there will be a gain. Long position. We are taking an example here of a long position of 80 units into 1000 price. Okay, the futures of X limited is being taken into the long position. Similarly, the short position is taken into futures of X Limited. So someone has taken a long position and the other person has taken a short position in the futures of X Limited, right? So which is on 80,000 rupees. Margin 20% at the rate of 80,000 rupees will have to be deposited with the stock exchange of 16,000 rupees. So since these are the future contracts, these are exchange traded, and in case these have to be exchange traded, there is a margin that needs to be applied. Okay, then on expiry, let's say the price becomes 70 and 90. So the person who has taken a long position, now common students, tell me, for the person who has taken a long position at the rate of 80, if the price on expiry becomes 70, will there be a loss or will there be a gain?
Loss.
Yes, there will be a loss because the prices have moved down. I have purchased something at 80, but now the price is at 70. So there is a loss of 10 rupees on 1000 units. Hence, there is a loss of 10,000 rupees. I will get the margin back. So ultimately, I am getting 6,000 rupees back. So ultimately, in the initial phase itself, I would have deposited 16,000 rupees to the stock exchange, right? Now, while returning on expiry, the stock exchange will only return me 6,000 rupees. They will deduct 10,000 rupees. Now, in case the price is 90, I will have a gain or a loss, students. Come on, tell me. The long position party will have a gain, yes, of
Gain on
10,000. Yes, 10,000 plus 16,000, the margin that we have paid. So in totality, we will get 26,000 rupees back from the stock exchange. Now, can you see the speculation? There is a hope of gain and there was a risk of loss. The risk of loss is in case the price is going to go down, there is a loss. In case the price is going to go up, there is a gain. Now, let's talk about the short position. So, short position also, let's assume these two outcomes. One is 90 and second one is 70. Now, tell me, students, if the prices have gone up after we have done the short position, then whether there will be a gain, there will be a loss.
There is a loss.
Loss. Very good. All of you are correct. So there will be a loss because I have sold something at 80 rupees. Now today the market price has gone up to 90 rupees. So that means I have sold it cheaper. There is a loss. Minus 10,000 plus 16,000. So net 6,000 I will receive. And in case of 70 rupees, I have purchased an item at 80 rupees. The current market price is 70 rupees. There will be a gain. Sorry, 80 here and 70 there. Okay, whichever way we can write. 70 minus 80 into this. So plus 16,000 plus 10,000. In totality, we will have 26,000 as the total gain amount. Clear? So we will be end up having a gain of 16,000. So this is just a speculation. Speculation is just one-sided movement, right? We don't have any other objective in mind. We just know that we need to increase the profits or we have to reduce the losses just by knowing that in which direction the market is going to move, taking the strategy accordingly in the respective directions. Okay. The second use was on hedging. Hedging means that you are already exposed to a risk and you need protection against that risk. protection against the risk. So the entity is already exposed to a risk hedging against that risk by using futures or forwards. Okay, so there is already a risk that is there. Now using futures or forwards, you will have to protect yourself. Now let's see how. Here I will list down the risk. Here I will list down the hedging strategy. Okay. So now let's take different scenarios and see what is the risk and hedging strategy. One, we are already holding equity shares in spot market. Okay, we are already holding equity shares in spot market. So there is a risk that the prices will go down. Risk that prices will go down. Correct? Because if I'm holding an equity share as an underlying, there is a risk that tomorrow if the price goes down, I will make it a loss. Now you have to devise a strategy that in case the prices goes down, you will gain from the futures. So what strategy will you devise? How will you make sure if the prices goes down, you gain? There are only two ways, right? One is sell futures and second one is buy futures. There are only two ways you can do it, right? Either you will sell futures, you will buy futures. Now come on students, tell me, will you buy futures in this case or will you sell futures in this case? Very good, Chitra. Chitra has reverted. Anyone else would want to attempt? So we are trying to make a benefit in case the prices goes down. Because we are already holding an equity share, that equity share is exposed to the risk of prices going down. Now, if the price is expected to go down, what should I do in the futures market to make sure that I gain if the prices goes down? Very good, Mamta.
We'll sell the future, sir.
Very good. We will sell the futures. I'm just emphasizing on this so that the building blocks in your mind is clear right from day one. Okay. So if the prices goes down,
We will take the opposite position.
yes, we will take the opposite position. Goes down. Okay. So here it will be a loss and here it will be a gain. So what you are doing? You are limiting your loss and you are limiting your gain. This is getting fixed and hence this is a clear example of hedging. Okay. So that's how the uses of futures and forwards are done. One is just to make a one-sided gain or loss, which is just a speculation, because here you just end up either gaining or losing, right? Here your objective is different. The objective is that you're already exposed to a risk, and using this hedging strategy you are trying to curb that risk. Okay students, clear? Any questions till now? Okay, so let's do one thing. Let's take a break of 10 minutes. We will again reconvene at 8:41. So yeah, before we break, so we discussed about the forwards, futures, their valuation, some of the compounding related issues and other discussions, and then we discussed finally that what is the use of forwards and futures in terms of the speculation and hedging. Now let's take an example. Let's say there are 100 shares which are purchased at the rate of 300 per share. This is done in the spot market. Okay, students, just remember this is done in the spot market, and here there is a risk of price going down. Okay, so futures, as we discussed, we will take a short position, and let's say the current price at which the futures are trading is at, let's say, 350 per share. This has happened in the futures market, specifically under hedging. Okay, now there can be different cases. Case number 1, 2 and 3. The closing price, let's say, is 300. Here the closing price, let's say, becomes 350, and here the closing price becomes as 400. So initially what we did, we purchase of shares 300 rupees each, and how many shares? 100 shares. So 30,000 rupees is what we would have spent in all the three cases in purchasing the shares. So students, whenever these kind of questions are there, right, so always make a cash inflow and cash outflow, okay, at the beginning and at the end. Using that, you will be able to make out that what is the net cash left, and hence that will be your net amount of profit or loss. Okay, so in this case we are talking about, first of all, the initial purchase, right? So the initial purchase will be at a 300 rupees, and hence 30,000 will be the cash outflow. The margin for short selling, you will also end up paying margin for short selling, right? Because this is a futures involves margin. So what margin we are assuming? Let's say 20%. 350 is the price of the future, 100 is the lot size, 20% is what the margin will be there. So 7,000 rupees will be the margin cash outflow that will be done initially. So in totality we will have 37,000 rupees each. That will need to be paid. Then about the sale proceeds. Okay. So sale proceeds, if the price is become 300, it will happen basis the closing price, right? So 100 into 300, which is 30,000. Case 2, it will be 100 into 350, which is the per unit price of 350, right? 35,000. And here it will be 100 into 400, which is the closing price in third case, right? Which will be 40,000, students. This is the sale proceeds that you will get, plus you will also get back your own margin. 7,000, 7,000 and 7,000. So this is the margin that you will get. And for the net settlement on futures, you will also need to pay or receive something. So plus minus gain slash loss on futures. Now students, comes the interesting part. We have entered into a short position at the rate of 350. What is the closing price? 300. Come on students, tell me whether there will be a gain, there will be a loss.
Loss.
No, again 350 is what we have entered at a short selling. We have sold at 350 and we are buying it back at 300. Will there be a loss? Will there be a gain?
Gain.
Gain. So there will be a 5,000 rupees gain plus 5,000. Okay. The second case, 350 is what we have short sold and today also the price is 350. There will be no gain, no loss in the current situation. Third case, we have purchased at 350. Current market price is at 400. Tell me students, will there be a loss? Will there be a gain?
Here it will be loss.
Loss of 50 rupees.
Loss. Yes. So 5,000, 50 into 100, 5,000 will be the loss. So the net amount we are receiving is sorry, 42,000. Here it will be 35 and 7,000. Again 42,000. And here also 40 plus 7, 47 minus 5. Again 42,000 students. So 37,000 in a row we have paid. 42,000 is what we have received. Net 5,000, 5,000 and 5,000 is what we are gaining from this. Clear? And this can also be demonstrated as like this. Futures selling price was 350 minus the purchase at spot price was 300. So in a nutshell, 50 rupees is what we have gained. It's not 50,000, it's 5,000 actually. Okay, 5,000 is the gain per share. Clear? Now, the linking is very simple. Long position derivative and short position. Long position means what? Contract to buy. On expiry, this is a contract. This is a contract to sell on expiry. Okay. The contract to buy on expiry, contract to sell on expiry. The future price is determined using the same formula that we have discussed. Now here, the risk is what? In case of a long position, what is the risk? The risk is exposed to the risk of downside. Here, you are exposed to the
Upside.
risk of upside. Very good. If the price goes up, you will be in a loss in case of a short position. If the price goes down, you will be at a loss in case of a long position. Clear? Now let's come to the first question as a part of the assignments that was shared with all of you. Suppose that there is a future contract on a share presently trading at rupees 1000. The life of the future contract is 90 days, and during this time the company will pay dividends of 7.5 in 30 days, 8.5 in 60 days, and 9 in 90 days. So they have given us multiple dividends. So this is first of all a discrete dividend or a continuous dividend, students? Come on.
It is a discrete dividend.
It is a discrete dividend because dividend is being paid in different intervals. So the first interval is 30 days. Second interval is 60 days. And last interval is 90 days. First interval 7.5, second interval 8.5, and third interval 9 rupees. Assuming that the compounded continuously risk-free rate of return. Now please focus, they are talking about the continuous compounding at the rate of 12% per annum. You are required to find out the fair value of the contract if no arbitrage opportunity exists, value of cost to carry, and they have given us certain things. So fair value of the contract means what? Fair value of the contract means the future value, right? That we can find out first of all. So we are talking about here a future of 90 days A, present value of dividends. Let's see the present value of dividends. There are 3 dividends, right? 7.50 into. Now, what rate we have given in the question? We have been given a rate of 12%, but this is a continuously compounded equivalent rate. And we have also been given e raised to the power some of the values, right? So we will make use of this. So e raised to the power okay, wait, let me just explain you clearly. So what happens, students? Let me just put it down here. If A is equal to P e raised to the power RT, this was our usual formula, okay? A was the future value and P was the present value. Clear? Now in this, if I have to reorganize it and if I have the future value and I have to arrive at the present value, what I will do like this, right?
Okay. Inverse.
Yes, the reverse. So it will go down, or can I also write it as P is equal to A e raised to the power minus R into T. Because 1 by e raised to the power RT, if I just want to remove it from the denominator and bring it to the numerator, in the power we do minus. So e raised to the power minus RT. Is this formula okay with all of you?
Yes, sir.
Yes, sir.
Perfect. So 7.5 is the future value, right? After 30 days. And for this, we are trying to calculate the present value. So 7.5 into E minus 0.12, which is the 12% rate, into 30 divided by, just always see, are they saying to assume anything in terms of the number of days? No. So let's say it is 360 days plus 8.50 into e raised to the power minus 0.12 into 60 days divided by 360 plus 9 into e raised to the power minus 0.12 into 90 days divided by 360. So using, this was done using a is equal to pe raised to the power rt, or p is equal to a e raised to the power minus r into t, students. Clear? So these are the present value of dividends. So hence the present value of dividend is equal to 7.5 into e raised to the power minus 0.01 plus 8.5 into e raised to the power minus 0.02 plus 9 into e raised to the power minus 0.03. Now these values are given in the question, right?
Yes, sir.
So we can make use of them: 0.9905, 0.9802, 0.97045. Okay, so this will become 7.50 into 0.9905 plus 8.5 into 0.9802 plus 9 into 0.97045. Present value of dividend. If we multiply this, it will become 7.43 plus the second multiplication 8.33 plus 8.73. In totality, it becomes 24.49.
24.49.
Yes, very good. So these all becomes the present value of the dividends, right? 3 different dividends are to be paid. The present value is this much. Now the fair value of futures contract will be 1000 is the spot price into e raised to the power. Okay, let us write the formula first. Using a is equal to p e raised to the power r into t, right? This is the formula this we will be using. So 100 into e raised to the power 0.12, which is r, for 90 days, correct? Minus 24.49 put together. So minus present value of dividend, correct?
Sir, we studied that the present value minus the present value of dividend plus cost. But here it's other way around, sir.
Okay, in the formula you are saying, okay, so I'll tell you. Just a second. This one you are saying, right? So it can be, okay, I'll tell you, it can be both way around. Okay. See the, no, I think you're right. This has to be this way only. So P minus present value of dividend plus present value of transaction cost into e raised to the power RT. Let's do this correction here. I hope you are indicating this only, right?
Yeah, I'm indicating that only, sir.
Yeah. No, you're right. This should be this way only. But if you see the solution, okay, the way it has been drafted, I think both the methods are acceptable. Okay, but for us, let's take the straightforward approach, which is the single approach here. Just a second. Let me just move this. So 100 minus 24.49. This is the present value X of dividend, right? Now let me just see in the question. Okay, yes. So this minus this and then multiplied by e raised to the power 0.12 into 90 divided by 360 days. Okay. E raised to the power RT. Okay. Now, if we solve for this, so this becomes 1000 minus 24.49 multiplied by e raised to the power 0.03. Correct? And this e raised to the power 0.03 is given in the question as 1.03045. Now, if we solve for this,
Yeah, it's 1005.21.
just a second. Yeah, 1005.214, right?
Yes, sir. 1005.214.
Yes, perfect. Or if you would have solved the other way around, which was the first thing that I mentioned, because in the solution, even that is also permitted. Okay, from the place where this has been picked from the study material or from I think the previous attempt questions, even the suggested answer also indicates that we can reduce it afterwards, right? So in that case, the solution would have been 1005.96. This is the second option, okay? But since we discussed about the formula above, we will stick to this only, okay? So this is the fair value of contract.
Sir, your voice is clear, but it's look like some radio sound. Krrrr.
Okay, from the background you are saying?
Yes, sir.
Is it faced by others also?
Yes, only when you speak.
Yes, sir. It's like mic problem.
Okay, let me do one thing. Let me again reconnect. Just give me a moment. Hello, is it better now?
Yes, sir. Better not. Perfect.
बेटर ना ओके अशोक जी आपको मेरे को एक बारी होस्ट बनाना पड़ेगा दोबारा से then only I can on my video. Okay, meanwhile this is happening. So the fair value of futures contract. Okay, thank you. Okay, I hope it is proper now, audible and visible clearly.
Yes, sir.
Perfect. So the fair value of futures contract becomes 1005.214. Okay. Now the next part of the question, it was asking the value of cost to carry. So basically the cost to carry is nothing but the difference between the future value and the present value. So the second part is actually cost to carry is equal to future value minus present value, right? So, or in other words, we can also say that the future value is equal to spot price, which is the present value, plus cost to carry, right? This is just the other way around. So in this case, it is 1005.214 minus 1000, which is 5.214. So the cost to carry becomes 5.214 students. Clear?
Sir, which means the cost to carry means which is nothing but the interest cost?
Interest cost, yes. It is just the interest differential between both the numbers. Clear, students?
Yes, sir.
Okay. Now let's come to the second question. Okay. A company is long on 10 metric of copper. So now what do we mean by long here?
Long means is selling.
No.
Buying.
Sorry.
Long means it's in a buying
Long
position.
means buying. Short means selling.
Yeah. So long is the buying position, right? So the company is in a buying position. That means company has already bought 10 metric ton of copper at the rate of 534 per kg, which is the spot price, and intends to remain so for the ensuing quarter. And it intends to have a long position itself in the ensuing quarter. The variance of change in its spot and future prices are 16% and 36% respectively. So the changes in spot price is 16, the changes in the future price is 36, having correlation coefficient of 0.75. The contract size of one contract is 1000 kg. Okay, don't get, confused. These are just some of the elements which we have not discussed yet. So through this question, I will be discussing one more part. Okay. So correlation coefficient of 0.75 means that if let's say the spot price and future price are moving in a certain direction, correlation coefficient will tell that what is the degree and extent to which that they will move. Okay, 0.75 means that 0.75 is the link between spot and future price. If spot price increases by 10, future prices will increase by 0.75 times of 10, right? Some of the degree it tells, right? The contract size of one contract is 1000 kgs. Required, calculate the optimal hedge ratio for perfect hedging in the futures market. Now students, please note that these three elements that have been given, one is percentage change in spot price, percentage change in future price, and the third one is correlation coefficient. Correlation coefficient. These three things are used to calculate the hedge ratio. So students, till now, in all our discussion, we have been making an inherent assumption that one share in the spot is used to hedge one futures in the future market. So the always ratio is 1:1. But in reality, it is not. It can be 0.75, it can be 0.8. So for hedging one equity share, you need to only enter 0.8 of the future value, not the entire one, right? So this is called as hedge ratio. Hedge ratio is something that how many futures you need to deal with to hedge your one equity share in the underlying. Okay, this is called as hedge ratio. So optimal hedge ratio is given by R into standard deviation of spot price divided by standard deviation of futures price, where R is actually the correlation coefficient between changes in spot price and future price. That is R. R is actually the correlation coefficient between changes in the spot price and future price. This is what it is mentioned in the question also. Standard deviation of S is actually the standard deviation of spot price. Standard deviation of futures is actually equal to the standard deviation of futures price. Clear? And hence the variance of spot price is actually 16%. Now can anyone tell me, if variance is 16%, what will be the standard deviation of spot price?
0.4.
Very good. So under root of 16, which will be 4%. Variance of future price, %36, right? What will be the standard deviation of this?
6%.
Yes. Of futures price is equal to under root of 36, which is 6%. Clear? So this was one of the tricky part in the question, that to calculate the optimal hedge ratio, you need to know what is the standard deviation of both and what is the correlation coefficient of both. So how can we derive now optimal hedge ratio? Easy now, optimal hedge ratio. Now we have all the elements, we just need to put in 0.75 into 0.04 divided by 0.06, which is equal to 0.50.
0.499, 0.5.
Yeah, 0.50. This is approx. Okay. Now, for hedging 1 equity share in the spot market. Futures, you need to only enter 0.5 shares. That's the linkages, okay, of the optimal hedge ratio. Advise the position to be taken in future market for perfect hedging. Now students, tell me, what will be the position in futures market? For that, we need to know what is their position in the spot market.
It's a long position.
Long position, yes. Now what will you do? Okay, let me also write long position for how much metric ton? 10 metric ton into 10 metric ton. Now tell me, in futures market, what will you do? Which position will you take? And for what quantity you will take? Yes, come on students, tell me. I think the first part is easier. If you have a long position in spot market, which position will you take in the futures market? Come on students. Easy?
Buy position.
Sorry?
Buy.
No. Already you are in buying position in spot market, right?
Okay.
In
So
spot
we will do the
market,
opposite position. We will say sell.
yes, we will have to take a selling position. Why? The question comes why. So why we are taking a selling position, students, is because what is the risk that you are exposed to? In case you are already having a buying position in spot market, the risk that you are exposed to is tomorrow if the prices goes down. Now, if the prices are going down tomorrow, you will have to devise a position. In case the prices goes down, you gain. And what is that? In case we have a short position in the futures market, right? So short position. And this we will come to later. Okay, this is the third part of the question. So we will solve this later. Let's first write the second part, the position to be taken in futures market would be short position, as in the spot market long position is taken. Clear? Because we have already taken a long position in spot market, futures market we will be taking a short position. Now the third part, determine the number and the amount of copper futures to achieve a perfect hedge. They have given us that the contract size is 1000 kgs, right? So the number and amount we have to arrive at.
I think the optimum hedge we used 0.5. The
Okay?
metric ton is 10 metric ton, 10,000.
Yeah.
You multiply by zero point 0.5, it will 5 metric ton will come. One
Yes.
contract is equal to 1000 divided by 1000, it will 5 contracts, sir.
Right. Very good. That's the correct answer. That's how it will be. So, since the contract size is 1000 kg and optimal hedge ratio is 0.5, number of contracts to be short sold to achieve a complete hedge is equal to 10,000 kgs into 0.50 divided by 1000 kgs, right? Which is actually 5 contracts. So this is first part. The second part, amount which is required will be 5 contracts multiplied by
Future value.
1000 kgs again multiplied by the now we don't have the future value, so hence the amount we will take this 534 per kg itself. Okay.
Okay, in this case, shall we assume that spot price spot now is the future price?
Yeah. Because we have no other part, right? We don't even have the R, which is rate of return, through which we can arrive at the future value. Okay. So we are just saying that the for 5 contracts, this is the current spot price. This is the amount that is coming out to be. Okay. 26,70,000. This we can mention basis spot price given in the question. Simple. Okay. Now, clear, students, till now?
Yes, sir. Clear, sir.
Okay, perfect. Now let's come to the third question. This is a good one. Mr. Careless was employed with ABC Portfolio Consultants. The work profile of Mr. Careless involves advising the clients about taking position in futures market. That's what we are also doing, right? Till now, we have also been assessing that what is the right position in futures market that we have to take basis the position that they have taken in their respective spot markets, right? So that is even the work of Mr. Careless, and that is with the objective to obtain the hedge in the position that they are holding. Okay, so this is clear that they need to obtain hedge in the position they are holding. Mr. ZZZ, their regular client, purchased 1 lakh shares of X Inc. at a price of $22 and sold 50,000 shares of APLC for $40 each, having beta 2. Okay, having beta 2. Mr. Careless advised Mr. ZZZ to take a short position in index futures trading at $1,000 each contract. Okay. So Mr. Careless has already advised to take a short position of index futures, though Mr. Careless noted the name of APLC along with its beta value during discussion with Mr. ZZZ, but forgot to record the beta value of X Inc. Now there are 3 elements involved, right? There are 3 things involved. One is the shares of X Limited. Sorry, X Inc. Second, and that too, 1 lakh shares at the rate of 22. Beta is not known here. Okay, this is the price, this is the quantity. Then shares of APLC. Okay, let me also put action here. It is buy. Okay, now for APLC, how many shares? 50,000 shares for 40 each, beta as 2, but they have been sold here. So there is a selling position here. Okay. And lastly, index futures. How many thousand each contract? So the quantity is unknown as of now. Price is also unknown. Now tell me, students, what will be the beta of index futures? Come on. What will be the beta of index futures? Or let me ask you, what is the beta of an index? Let's say Sensex or Nifty, what is their beta? Come on, students. It's an easier one.
4.
What is the... Sorry?
4.
Why 4? What is the beta? Okay, first of all, what is the meaning of beta, students? Just think through what is the meaning of beta.
Risk of market.
Risk of market with a risk free.
So beta is sensitivity of changes of a particular security with that of the market, right? If let's say beta is 2, it means, for example, APLC, the beta is 2, right? So it means that if market is moving up by 10%, APLC will move up by 20%. So beta of APLC2 means this: if market is going down by 10%, APLC will move down by 20%. So it will move twice as much as the market is moving. Now, if I ask you, this is beta of APLC. Now, what is the beta of market itself? What is the beta of index itself? See, first of all, index is what? Index is market, right? Index is the collective.
It would be
Index
1.
is the... Yes, very good. So, index is the collective representation of the market. Hence, I was asking you that what is the beta of index? So, it will be sensitivity of changes of market with respect to that of the market. So, market related changes with respect to that of the market will always be 1. So, so the beta of this index futures will be 1. And we have taken, the Mr. Careless has advised to take a short position, which is sell in this particular case. Though Mr. Careless noted the name of APLC during its along with its beta value during discussion with Mr. ZZZ, but forgot to record the beta value of X Inc., which is fine. On next day, Mr. ZZZ closed out his position when share price of X Inc. dropped by 2%. So share price of X Inc., where the buying position was there, it has dropped. Share price of APLC appreciated. So share price of APLC, where there was a short position, it has appreciated. So both the things have happened in a reverse order, right? Wherever that person was holding the share, the prices have gone down. Wherever there was a short position held by this person, the prices moved up. So there was a loss there as well. Then finally, index futures also dropped by 1.5%. So this is okay. Mr. Z informed Mr. Careless that he has made a loss of this much due to the position taken. Since record of Mr. Careless was incomplete, he approached you to help him find the number of contract of futures he advised to Mr. Z to be short to obtain a complete hedge and beta of X Inc. See, now this question is asking you to calculate two things. One is, okay, let's understand from here. One is this, which is the number of contracts, and second is the beta of X Inc. Number of futures contract and beta of the first company was X Inc. Clear, students? And it has given you some broken piece of information that what is there. So let's create this portfolio of Mr. ZZZ X Inc. 1 lakh shares into $22. It was taken as a long position, but the share prices have moved down by 2%. APLC 50,000 shares into $40. It is a short position. The prices have moved up by 3%. And then finally, there is an index. 1000 is the lot size. There is a short position, but the prices have moved down by 1.5%. And in totality, there is a loss of $114,500. This is the total loss that has been incurred. Okay, so now let's come to the solution. Let the number of contracts in index futures be Y and beta of X Inc. be X. Okay. So these are the two missing elements. Let's assume both of them. One is Y and one is X. Now, 1 lakh. So the number of contracts. Okay, let's say the number of index futures that will be entered will be given by this. Number of contracts of index futures will be given by 1 lakh into 22 into beta, right? Minus, why I'm putting minus? Because the other one is a short position. 50,000 into 40 into 2, that's the total exposure divided by 1000, which is the lot size. Okay, minus Y is equal to this much. Minus Y, why? Because we are doing the short selling. That's why minus. Okay, so why are we multiplying with beta, the respective positions? Because you are hedging against the index. So what you are doing, you are taking the position amount, which is quantity, rate, beta, and then you are trying to see that how many index futures can help you protect against with, right? So that can only happen through beta, because beta is the common link between your individual prices compared to the market prices, students. So here it becomes 22 lakh X minus 5422 40 lakhs is equal to minus 1000 Y. Okay, so this becomes the overall equation. Okay, now let's say what is our cash outflow on opening day. Now, now, if you see in the entire question, there are two variables, x and y. So one equation we have formed. If we are able to make a second equation also, we can solve those two equations and those two variables can then be easily solved for. So the cash outflow basis the opening day will be purchase of 1 lakh units into 22. That means 22 lakh rupees is what we have given as a cash outflow, and we have also sold. So sale of 50,000 units into 40 is what we have also done, right? So that means 20 lakh rupees is what we have realized from here. So net 2 lakh rupees is the outflow that we have done. Okay. And apart from that, there is a short position in index futures that we have taken minus 1000y. So let's take it as is minus 1000y. See, I'll tell you why we are taking this. Although it's not a cash outflow on day one, right? On day zero, it's not a cash outflow. Any index futures you purchase. But why we are taking here is because we have to capture the price movements into our net cash inflow outflow after we square off all the positions. Hence, we are taking the complete 1000y here as the outflow, and whatever will be the inflow towards the end of the expiry, that we will be taking it as completely after reducing the price movements. Okay. So this becomes 2 lakhs minus 1000y. Okay. On next day, following positions would be calculated. Okay. Which are, first of all, the sale of X ink will happen, right? Whatever we had purchased, that will be sold. 1 lakh was purchased. What is the price now? So opening price was 22. The prices have moved down by how much? By 2%. So the realization will only happen to the extent of 98%. Correct? So we will be realizing plus 21,56,000. Then the APLC was already sold. Now today we will be purchasing the APLC. The purchase of APLC will be 50,000 into what was the price? 40.
40.
Yes, and where it has moved? It has moved up by how much? It has moved up by 3%, which is 1.03. Hence it becomes 20 lakh 60,000. This is what we will have to pay. Now you can always see that 22 lakh is what we have invested and we are getting 21 lakh 56,000. 20 lakhs is what we have realized, but we are paying 20 lakh 60,000. Clear? So this is the adverse movement that are impacting our profitability. Then the short position in index futures will be squared off by taking a long position now. Position in index futures, this will be how much? 1000Y was the original price. Now the index futures have gone down by 1.5%. So our cash outflow will be only to the extent of 98.50%. Okay, so it will be minus 985Y. So 2156 is what we will get, 2060 is what we have to pay, and 985 is what we have to pay. Similarly here, 22 lakhs is what we have to pay, 20 lakhs is what we have got, and 1000Y is also what we have got. Clear? So this becomes 96,000 minus 985Y. So the position on closeout. What will be the position on closeout? 2 lakh minus 1000Y minus 96,000 minus 985Y is equal to 1,14,500. So this will be the opening. This will be the closing. So if we solve for in this, Y becomes minus 700. So the number of contracts that were short sold were 700 contracts. Clear? And hence the beta of X Inc. can be calculated using equation 1, which was this one, right? Which was 22 lakh X minus 40 lakh is equal to minus 1000Y. So which is 22 lakh X minus 40 lakhs is equal to minus 1000 into 700. So X becomes 1.5. So hence beta of X Inc. is 1.5 as per the facts. Clear, students? Any questions till now? Please do let me know. Should we move to the next question?
Yes, sir.
Okay, perfect. So let's come to the next question. Question number 4. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio of shares in 90 days. However, he is worried about the expected price increase in shares in coming day, and to hedge against this potential price increase, he decides to take a position on a 90-day forward contract on the index. So now if you see, the expectation is that the purchasing will happen after 90 days. Okay. If the purchasing will happen after 90 days, the clear risk is that if after 90 days the price increases, then what will happen? So for that, they're trying to hedge against the 90-day forward contract. The risk is the index is currently trading at 2290. Okay, this is the current trading value of the index. Assuming that the continuously compounded dividend yield is 1.75 and risk-free rate is 4.16, you are required to determine. Now, in this case, they have given both the things as continuously compounded. You are required to calculate the justified forward price on this contract, which is very easy and simple. Suppose after 28 days of the purchase of the contract, the index value stands at 2450, then determine the gain or loss on the above long position. If at the expiration of 90 days, the index value is 2470, then what will be the gain on the long position? Note, take 365 days in a year and the value of e raised to the power something something as these. Okay, so this is a very simple straightforward question in which we just need to put the formulas and arrive at the values. So the A part. Now come on students, which formula should I use? This is a continuous compounded dividend and this is a continuous compounding for rate of interest as well. So the forward price would be given as A is equal to P e raised to the power R minus Y into T, right? This is the formula that we will use.
Yes, sir.
Perfect. Now here R was rate of interest and Y was dividend yield. So A becomes, what was the current price? 2290 multiplied by e raised to the power. This will be a calculation wherein 4.16% will be 0.0416 minus 0.0175 into 90 divided by 365. They've already said to take a 365 days and hence we are taking 365 days. Okay. So A is equal to 2290 into e raised to the power 0.005942, right?
Yes, sir. 005942.
Perfect. So which is given as 1.005960 in the question. 2290 into 1.005960. So this will be multiplied. It will become 2303.65. So this is the value of A. A, which was the future value, right? Future value basis the index value as on today is 2303.65. So theoretical, this we also call it as theoretical forward price or no arbitrage price. Okay, on this value there is no arbitrage that is possible. The second part, suppose after 28 days of the purchase of the contract the index value stands at 2450. So in this case what we'll have to do, we'll have to calculate the value, the future value on 28th day, gain slash loss on long position after 28 days. So 2450 is the new price minus 2290. What is the price after 28 days? So e raised to the power 0.0416 minus 0.0175 multiplied by 28 days instead of 90 days earlier, right? So now we'll have to find out that what is the future value after 28 days. Clear, students?
Yes, sir.
2450 minus 2290 into e raised to the power 0.001849, students.
Yes, sir. 1849.
Correct. Now this 1849, the value is given here 1.001851 minus 2294.24, which is equal to 155.76. This will be a gain or will be a loss? Come on, students, tell me. You have taken a long position. The price is higher. So will it be a gain? Will it be a loss? Come on, students.
Loss.
Gain.
Gain. It will be gain. It will not be a loss. Why? Because the actual price in the market is higher than your computed price, right? Or let's say your future value at which you have entered is 2294, whereas the actual price is higher. Then the last part. If at the expiration of 90 days the index value is 2470, this is very easy. Now you tell me, we have taken a long position, so gain slash loss on maturity will be what? 2470 minus what was the original expiry price? Theoretical minimum value was 2303.65. 2303.65, right? So now tell me, students, this 166.35 rupees of difference will be a gain or will be a loss? Okay, students, tell me. This is the spot price on maturity, right? And this is the theoretical minimum price. You have taken a long position at 2303.65. The actual price on maturity is 2470, which is higher. In case of a long position, if the prices goes up, you
It's
gain
a
or
gain.
you lose? It
Gain,
is a
sir.
gain. Yes, very good. It's a gain. So that was it. This question was relatively very easy and simple, right? Now, students, towards the end of today's session, we'll also like to have some of the MCQs with all of you. So I would request not to prompt the answer because everyone would give the answer. If you can write in the chat box and send it, so that would be better. Okay. And I will reveal the answer once all of you would have answered. So just participate in this because this is a good exercise to see and understand that whether all of you have understood the today's concepts or not. Which of the following is not a characteristic of a forward contract? It is traded on an exchange. It is a customized contract. It involves counterparty risk. It is settled at maturity. Come on, students. You can just write in the chat box about what is the right answer according to you. Come on, students. This is very easy, right? Which of the following is not a characteristic of a forward contract? Very good. Chitra has reverted. So just see that what all things are there in a future and what all things are there in a forward contract. Yes, Sanjay. Perfect.
Sir, I'm also responded. Did you get that?
Sorry?
I am also responded, sir. Did you get me now?
No, I am not able to get it.
Okay.
I was also
I would see there is a two name of yours, Divas Gupta and CA Divas Gupta. Which one I need to search?
CA. No, put it in CA Divas Gupta
yes,
because the
I
one
was
is on
also
the
I
iPad.
was also responding in other one.
Okay. No worries. Okay, now
Okay,
I'm getting all the responses. Leela, you are right. Saminathan, you are right. Mamta, okay. Mamta, you've also responded. Okay, now I'm getting all the responses. Very good. So the correct answer is it is traded on a exchange. So the question is drafted, which is not a characteristic, right? So forward is not traded on a stock exchange. Hence, this is the right answer. Okay. So thank you all of you who have responded, and I think most of you are right. Second, the primary difference between a future contract and a forward contract is futures are standardized and traded on exchange, while forwards are customized and traded OTC. Forwards are mark to market daily, while futures are not. Futures have counterparty risk, while forwards do not. Forwards require margin, while futures do not. So you have to point out that which one is the right answer in terms of the distinction between both of them. Yes, very good. Very good, Chitra. Very good, Saminathan. The correct answer. Very good, all of you who are responding. So the correct answer here is option number A, which is the futures are standardized and traded on an exchange while forwards are customized. Okay. If the spot price of an asset is 1000, risk-free rate is 8% per annum compounding. The forward contract is for 1 year. The theoretical price, ignoring dividend, will be what? So it's a continuously compounded. I think you will need the e raised to the power something. So let's do one thing. We will do this question in the next class because this requires calculation. Which of the following best describes basis risk in the future contracts? The risk that the underlying asset price will fall, the risk that the spot price and future price do not converge at maturity, the risk of default by the clearinghouse, the risk of interest rate changes. Now, students, please try to link what is the basis risk. Just try to link, you will be able to get it. What is the right answer? Is anyone attempting? Okay, people are responding. Saminathan, Sanjay. So, which of the following best describe the basis risk? Basis risk is basically the changes in the interest rate risks, right? So, okay, what I'll do, so basically we have not covered this though. So the basis risk is that the risk that the spot and the future prices do not converge at maturity. Okay. In a cash settled futures contract at expiry, what needs to be there? Physical delivery of the asset takes place. The difference between the spot and future prices paid in cash. The contract is rolled over. The contract is automatically renewed. Come on, students. Come on, students. What is the right answer? Yes, very good. All of you are responding. Correct. So the right answer is this. The difference between the spot and the future prices paid in cash, because these are cash settled future contracts expiring. Okay. So yeah, student, that was it from my end for today's session. So we will continue our discussion in the next session. I would request C. Ashish sir to please help with the closing remarks. Thank you.
Sir, in question three, I calculated beta comes to 2.14. I
In
think.
today's question 3,
Yes.
wait, let me go there. One, two, and 3. Yeah, this one.
Yes.
Why you got beta as 2.14? Have you taken here as minus or plus? Just check this once.
Minus.
Okay, wait, then let me do. So this is what? 7 lakh 47. No, wait, I think, wait. I have made a mistake here. It
So
should
why would
be,
be minus 700?
sorry.
Why would be minus 700?
Yeah, y would be minus 700. So this
Minus
is,
1000 into minus 700.
so this will be 40 lakhs minus 7 lakhs, right? Is equal to 22 lakh x. The way we will solve this, so x will be 33 lakh divided by 22 lakh. So x is 1.5 only. So the answer is correct only.
So minus 1000 into minus y. Y would be minus 700.
Okay, no. We will not take twice this minuses, na. See, okay, y is already minus 700, na. See, for doing the short position, okay, let me go to this one. We have only taken once this minus. I think you're taking minus twice, and hence you are getting the other answer.
Yes.
You should not take it twice, na, because it is only once that you will take minus. If you are substituting minus y,
But the equation is equal to minus 1000 y. And y comes to minus 700. That is why I
yeah,
took twice.
no, I'll tell you. See, okay, the why this is coming as minus 700 is if you swap this, it will not come. So basically, closing minus opening, if you do, it will not come 700, right? So I'm saying that twice you cannot take minus, na. Only once you will have to take minus, right?
Okay, I will
Which
check.
is you
Okay.
in the formula you have already taken minus. There is no need to take again minus 700.
Okay.
If you are doing, yeah, if you are taking y is equal to minus 700, then no need to take minus here.
I got it. I will check it. Okay.
Okay.
Yes.
Yeah. Yes, sir. Yeah. Thank you. Handing over to Ashish, sir.
Thank you, Devas sir. So when you have started the session, you have started your discussion with the explaining what is the derivative, and as its meaning is word is it implies deriving something from something else. And student, please note that this topic is important from two or three reasons. First of all, I want to make a disclaimer whenever this topic is started. So please note that this derivative topic discussion is mainly for the academic purpose only. So we are not here to encourage to enter into any derivative position for the speculation, because it is in addition to hedging, it also used for the speculation as well. Of course, we are touching upon the speculation part as well, but we never encourage the speculation at this time because now you are studying, and please concentrate on your studying. So our purpose is solely academics only. And second thing, this topic forms the basis of hedging in the foreign exchange. That is the next topic. So in the next topic, when we shall start discussion where the forward and future contract will be used, another variant of derivative contract will be used. So there we will not explain again and again. Only the difference will be of underlying. Here the underlying is generally index futures. Okay, even stock futures can be an underlying, but in a foreign exchange, it will be the foreign exchange. After one topic, that is international financial management, there is another topic, interest rate risk management. Again, in this topic, the basics that have been discussed here will be used there, but only the difference is that there the underlying will be the interest rate risk, interest rates. That will be the interest rate, how we hedge the interest rate risk. So from the derivative, first we start with how we hedge our cash position. Then we move to the discussion of how we hedge our foreign exchange position. Then with next topic is how we hedge the interest rate risk, hedge our interest rate risk. So that's why this topic is very important from the basics point of view as well. So student, I hope since the discussion was very interactive, so you must have understood whatever the points have been covered. Now this topic will be continued in the next class. And thank you, Divas sir, for sparing your precious time, and
Thank you,
thank you,
sir.
student,
Thank
for
you.
patiently listening and making session interactive. Thank you. And just before going, Divas
Yes,
sir,
sir.
just share
Yes, sir.
our telephone number. This is 0120 3045 956. And our email ID is sfm-final @ICAI.in. Okay, student. So you can send your query as well on this. Can contact me with over the telephone, or you can send your email at this email ID. Thank you very much, and have a
Sure.
nice. Thank you.
Thank you. Thank you. Thank you, sir. Thank you all.
Thank you.
Thank you, sir.